Hey guys, welcome back to another episode of the Bizzin app training sessions. Today we are jumping into private companies and we are still in the series of choosing the right legal structure for your business. Just touching again quickly on why it's important for you to make the right decision. 4 different aspects that's crucial when considering the right legal structure for your business is your different risk factors, different tax implications, your different compliance implications, and your different opportunities from investors. So when you are making your decision, take into consideration all these 4 aspects, and we're going to jump into more detail on every single one, but it's important to look at that. Then the different legal entities that we are covering in this series is your sole proprietor, your closed corporations, which you can go back to in episode 1 and 2 just to hear more about that. And then today we are doing private companies, and then we'll touch in the future on trusts, incorporated, non-profit companies, and partnerships. Great, so if we're just jumping into a private company explained, so the same as a closed corporation, your private company is a separate legal entity that can own property, can enter into contracts and sue or be sued in its own name. So as a sole proprietor that we touched in the first episode, you are the business, so you will enter into the contracts in your personal capacity. Essentially, you will make debt in your personal capacity, you can sue or be sued in your personal capacity, where with a private company, the legal entity, which is a Pty Ltd, will enter into the contracts. And so it's important to know that it's not going to be you in your individual capacity, but the legal entity, which is called a private company. Limited liability with simple management. And then in terms of this, is owned by shareholders who can be natural persons or trust. And I can actually add there, other companies can also own shares in a company. And so it's your shareholders here becomes different from the people that's actually managing the company. It can be the same person, but it doesn't need to be the same person. So you can have person A being the shareholder or 100% shareholder of the company, person B merely just being the director that needs to make sure the company is making money. So it has directors who act as the decision makers for the business, and then you can have any number of shareholders. So once again, just jumping into the South African Revenue Service definitions for a private company. A private company is treated by law as a separate legal entity and must also register as a taxpayer in its own right. It has a life separate from its owners with rights and duties on its own, and the owners of a private company are the shareholders. The managers of the private company may or may not be the shareholders. And then under the current Companies Act, private companies are no longer limited to 50 members. So a very important aspect just of a private company is that your shareholders and your directors are individual people, but it can be the same people as well. But in a closed corporation, your members, so your owners and your members were exactly the same people. Here in a private company, your owners can be separate from the directors. Okay, jumping into some of the key characteristics of a private company. As we mentioned, it is a separate legal entity, so you are not the business. Each shareholder owns a portion of shares of the company, which the company is allowed to issue. So the company will issue shares, and then there's shareholders, there can be multiple shareholders that buys some of those shares that is available to be, that was issued out of the company. It can have an unlimited number of shareholders because it depends on how many people want to invest into that company. It has limited liability, so shareholders are not personally liable for the debt of the entity unless, once again, they acted recklessly, fraudulently, or signed surety. So the same as a closed corporation, the directors or the shareholders will not be kept personally liable for the debt of the entity, except if they traded recklessly or fraudulently or signed personal surety for that debt. The directors represents the shareholders. So in this case, when a shareholder owns the shares in the private company, that shareholder has the right to employ a director that makes a decision on behalf of the shareholder. So the director essentially at the end of the day represents the shareholder. So the director's responsibility in a private company is to make sure that that company becomes profitable so that the shareholders at the end of the day can get their return on investment and their dividends, which they want every year. And so then the entity can continue to exist even if a director or shareholder dies or resigns, because it has the perpetual succession. So also very important to know that even if one of the directors passes away or decides to resign or move on to another place, then it is important to know that that private company still continues and the business inside of that company still continues unless you guys decide to close it down, to deregister or to liquidate that. And then the private company is taxed at corporate tax rates. It is regulated by the Companies Act of 2008. It requires a Memorandum of Incorporation. Very important, because the Memorandum of Incorporation, so most of you would see if you do register a standard company from CIPC, that CIPC does issue a standard Memorandum of Incorporation, which would cover just the name of the company, the address, how many directors must be there, how many shares are authorized and issued. But you can also compile a manual Memorandum of Incorporation if you are entering into a company or an agreement with some of the shareholders or multiple people. You guys can compile your own Memorandum of Incorporation, and that is essentially a document which you must see as your foundation of the legal entity. When meetings must be done, how decision making works, when a special resolution or a normal resolution takes place. And it's important for you to know and to make sure that you always have that in place from the beginning. And then directors are taxed separately on drawings or salaries. So just some of the advantages of a private company. It is a separate legal entity. It has limited liability. Flexible management, as we discussed before. It has that continuity of people climbing on, climbing off, which is also important to know that when shareholders they can sell their shares and a new investor can come on, so, and the directors can stay the same throughout while shareholders sells shares between each other or they sell shares to the company. And that is also something that is important to touch on when creating the Memorandum of Incorporation, like what can happen and what can't happen in terms of shareholders. And then investors friendly. This is one of the structures that investors love, because they can buy shares and they can own a percentage of that a legal entity without having to make decisions on a daily basis to make sure that that company becomes profitable. So they can just merely keep on investing and they can get their dividends and profit shares every year. And in a private company, it's easier to scale because of the fact that you can have multiple shareholders, you can have multiple investors, there can be multiple directors, so it is a scalable entity at the end of the day. And then some of the disadvantages of a private company: more compliance. And I think a lot of you these days would understand if you've already registered a private company before, or if you're going into it. These days you need to have a beneficial ownership that takes place. You need to have your share certificate. You need to have your share register. It's important for you to make sure that you have all of those documents in place to always make sure that it is a valid legal entity that you are trading in. Because if the legal entity that you are using is not valid and is null and void due to certain things not taking place, it becomes again as if you are a sole proprietor, and it seems that that whole business is run out of your personal capacity. And another point is the director's responsibilities, because according to the Companies Act, the directors has certain aspects that they need to comply with, certain laws and regulations they need to comply with to make sure that the company is operating legally and above board. And then also more admin, it needs to comply with the Companies Act. So you'll see when you do register the MOI that there are certain things where you need to have minutes done on an annual basis. You need to have directors meetings done. You need to set up your annual financial statements. So there is a little bit more admin. But once again, I always choose to see it as a good thing, because when you go through all of those laws and regulations, you'll actually start seeing the more you implement that for your company, it gives you time to reflect on your business. It gives you time to make proper decisions in your business. So it's actually an added benefit. Even though we might feel that it's a burden and there's so much paperwork going into it, I think you just need to see it as an opportunity to scale the business more, to streamline the business more, and to implement better things for the business. Going quickly into legal compliance again. Once again, as we've touched with sole proprietor, as we've touched with closed corporations, your private company also has legal compliance that it needs to pertain with. And so directors must register for personal income tax, and you'll often find these days with your beneficial ownership as well that the shareholders must also provide the personal income tax number. Your private company must register for income tax, and automatically when you do register at CIPC for a private company nowadays, you do get your income tax number automatically from that from CIPC. And then your private company must register as a provisional taxpayer. We've touched on a previous episode, every legal entity must register for provisional tax. So provisional tax is just also essentially 2 times in the year, so 6 months after your financial year end, and then on the financial year end, you need to do a calculation to determine whether there's taxes payable out of the entity and then pay that over to SARS. So if you employ people, you must register for payroll taxes, which is then the UIF. You must deduct the pay as you earn from them and pay that over to SARS if they are over the threshold. And if they have if your company or your business has more than 500,000 Rand in salaries on an annual basis, you must register for STL, which is your skills development levy. And then also an important point, if your turnover does exceed R1 million in a 12-month cycle, you must register for that. It becomes mandatory. And then your company must also have annual financial statement, because when you do submit your income tax to SARS, SARS will ask for that annual financial statements, and also it is a regulation and a law according to the Companies Act. So just some of the compliance for CIPC. CIPC wants your accounting records to be up to date, and they actually do ask about that when you submit your annual return as well. COIDA registration, if you have more than 1 people employed, that's not necessarily a CIPC, but more Department of Labor regulation. But I needed to add that because I think it's an important aspect, because a lot of people misses that registration. So if you employ 1 or more people in your company, it is important to register for workman's compensation, because if that employee gets hurt on the job and you are not registered there, you will have to pay all those medical costs and everything out of your own pocket. All right. And then you need to comply with the Companies Act 2008. So what that also means, just to comply with that, it's important to understand if your company becomes technically insolvent, or it is insolvent on paper on your annual financial statement, you must actually inform the CIPC about that. So it's important to know what the Companies Act is saying regarding the insolvency, regarding your business, regarding liquidity and everything, regarding your minutes and the meetings. And so it mustn't be seen as a burden, it must rather be seen as how you as a business owner can operate more effectively in your business. Then your annual returns that need to be submitted once a year. And with the grey listing that happened with the beneficial ownership, CIPC made it more difficult. So if you do not submit your annual returns for 2 years, CIPC automatically deregisters your company then, and then you need to go through the whole process to register that again. But we will do a video on beneficial ownership and annual returns where I explain a little bit more about that. And then in your private company, once again for CIPC, you must also have your annual financial statements. And then just some of the key takeaways for your private company. It is one of the most flexible structures in a legal entity. It's very scalable. It's a legally protected business structure. It provides framework for sustainability, and it is very investors friendly. So private companies can now grow without limits, able to bring in unlimited shareholders, attract more investment and scale freely while staying fully private. So that's very important. The legal structure that's registered the most these days is private companies, and I would presume if you are watching this, it's probably something that you are also going to do for your business. And it's just important that you know what the right legal structure is for your business to make sure that you can grow and become successful in the thing that you are doing. Thank you for joining this training session, and stay tuned for our next one.